Want to know how elite tax advisors win the due diligence game to satisfy ultra high net worth clients who expect the very best? Welcome to the Due Diligence Project podcast, where you get a chance to learn from the elite CPAs, virtual family office professionals, and tax specialists who are doing just that. We'll uncover their insider secrets on how they are dominating their competition, vetting new ideas, and supercharging their due diligence process to deliver extraordinary results. Bringing his 25 plus years of experience with top tax professionals across the country, please welcome your host, Alex Sunkin.
Welcome to the Due Diligence Project podcast. We are so excited to have today's guest, Mr. Wesley Sierk, who's an elite captive specialist. He's a best-selling author. He's a thought leader. He's also a movie producer, producing a number of movies using tax dollars. He's also a great friend of mine, and he's one of the smartest people I know, author of a book called Taken Captive, and You Can Make It, But Can You Keep It? Am I missing something, Wes?
No, that's pretty much it.
You're a very, very humble man. Hopefully in this podcast, we're going to kind of pull some stuff out of you and get you to talk a little bit more about yourself. But our audience wants to know, what is it that you do and how do you help people? And, what the heck is a captive? But let's just talk about whatever you want to talk about, but that's a good starting point.
All right, perfect. Well, I mean, a captive, it's an insurance company that a client of ours sets up to insure their own risk. Stepping back into how I got into captives, it was about 2001. I was selling insurance, and I realized the insurance companies always had more money than I did. No matter how much I sold, you sell $1 million in premium, they give you 6% in commission. I'm like, I want the $1 million premium, not the $60,000 commission. So
Yeah,
that's where,
because your head's starting to see all the numbers. You're like a numbers guy. You're like, wait a minute, I'm doing all the work here, and the insurance company's getting the money. I'm going to own the insurance company. Got it.
Yeah, exactly. And then there's a guy named Andrew Tobias. He was, some of your older people in the audience may understand who he was, but he was really big. He's like the first finance self-help guru back in the late 70s, early 80s. And he came out with a book called The Invisible Bankers. And it's all about how insurance companies work and how the assets and liabilities and everything they're given preferential tax treatment to make sure that they can accumulate a lot of money. So in the event that they have a claim, that there's money to do that. So I went down this whole rabbit hole. I'm kind of a researcher by nature. So what I did was I said, I want to get into the insurance business. So I decided to learn all about it, went deep, super deep, and figured out how insurance companies worked. As a result, formed my own insurance company.
So you have your own insurance company. Tell us about that.
Correct.
For a minute.
When we started, it was just doing workers' comp in 13 states. And then what we did is we said, let's take that knowledge of what we did to form our own insurance company and bring it out to the general market, bring it out to small business.
So as an owner of an insurance company, you work with the federal government and their regulations, and you also work with these 13 state governments and their specific regulations. Is that fun?
Yeah, well, it's not really like that, because insurance is covered by the Department of Insurance in the individual states.
Right. It's
the Congress that allows the insurance company to be taxed a certain way. But you have to deal with each of the regulators from all those different states in order to run an insurance company.
And how fun is that, dealing with regulators?
Not fun at all. Yeah, no, not.
So really, in setting this up, you have to do a lot of due diligence in terms of understanding which state makes the most sense. Like, how did you choose the 13 states? Why not all 50?
Well, with workers' comp, it's the ones that are most profitable. Certain states are better to do business in than others. Certain states, the people pay a lot of money for workers' comp, and their claims are less. To give you a general sense, the reason why we chose workers' comp was workers' comp is a 50% margin business.
Got it.
So if a client pays $1 million in premium, we expect to pay out $500,000 in claims. But that $500,000 trickles in over a long period of time. Even if it's $500,000 in claims, it may be 100 this year, 200 next year, 200 the year after that. So we have a long amount of time, but we're holding on to that money the entire time. When Warren Buffett said, that his best investments he ever made were in his insurance companies, because that gave him an unfair advantage over the rest of his peers.
And so what I'm hearing is you and Warren Buffett have identified, and insurance companies are all different, right? Workers' comp has a different profit margin than other different types of insurances. You guys identified owning insurance companies a very, very unique structure. There's a lot of risk elimination benefits. There's a lot of tax elimination benefits, a lot of cost efficiency that happens when you own an insurance company and maybe combine it with other strategies. And so you identified, hey, I want to own a workers' comp insurance company for a number of different reasons. You did a lot of due diligence, and that's what you came up with. And now every dollar of premium that you earn, you're making 50-cent profit. That's about right?
Correct. Yep.
Got it.
Yeah.
When you help clients outside of someone who needs workers' comp, right? Or when you talk about,
can I stop you there? Because
Please.
we're not, we don't run that company anymore. Because our captive insurance business got so large, and the complexity of state regulations for all these different states and paying claims and stuff, to me, the juice just wasn't worth the squeeze.
Got it.
So we were making better money doing our other managing captives. Now, we do have a client in Hawaii. We manage a fully licensed, regulated insurance company for a client. They're a staffing client in Hawaii. So they were making, we set up their insurance company, and it just kept getting bigger and bigger and bigger. So then we said, well, why don't we just make it a licensed, regulated insurance company? So now they can sell insurance. It started off as a captive, and now it's a licensed insurance company, so they can sell workers' comp to anyone. Now they make probably 3 times the amount of profit on their workers' comp business as they do on their staffing business.
So, wow. So when you think about a typical client of yours, and I know you service our community of independent elite family offices, elite CPA firms, and you come in, we bring you in as a dynamic thought leader and resource because you understand a number of different strategies. But your typical client, and I guess you may have a number of different types of clients here, but give us a range of what you're doing for your typical client A or typical client B in terms of someone needs your help. Why would they reach out to the due diligence project to kind of bring you in?
Okay. Well, we don't, the greatest part about my job is we don't have a typical client. We have clients in all different industries, from boat builders to energy drink companies to a collection of 14 high-end plastic surgeons, manufacturing, and it's all over the board.
What's the range in net worth, say, of your clients? Just let's start there and then go in a little bit.
Okay, I would say they all are doing, let's say $10 million in revenue and above. I would say the average is probably 50 million.
Can you give us a number at the high end of the range?
We have 2 clients that do. One does $3 billion a year in sales. One does $15 billion in sales. Okay, $15
billion a year in sales is a pretty good number, I would say.
Yeah,
that's a pretty high. It's an A+ type client. Okay,
but it's really not to dispel the myth, but we get paid the same amount of money to manage an insurance company for somebody that puts in $200,000 a year or $27 million a year.
Well, we appreciate that, because our job is to find the very, very best captive people in the world. And our clients keep asking us to keep finding the very, very best. We keep looking and we keep looking and we keep looking and we keep coming back to you. Of course, we know number 2, number 3, number 4, number 5. We keep trying to prod them to get better than Wes Sierk, but no one seems to do that. And that's why we're talking to you today. So this is awesome. What do you think the biggest challenge? Look, you've got a full range of clients. Tell me some of the biggest challenges that they're facing that you guys are set up to fix.
Yeah, well, if you asked us this question 3-4 years ago, we would have a completely different answer than we do today. Over the last 24 months, I would say the majority of the engagements have been in the area of health insurance and workers' comp, a large amount in health insurance, because with this Affordable Care Act, it's, the premiums are not going down. The system is rigged against the business owners, and it's rigged for the insurance companies. When they passed the Affordable Care Act, Nancy Pelosi was famous on saying, we'll pass it, then we'll figure out what's inside of it. And it's, and it's not a Republican or Democrat thing. It's just all of the elected officials came in and they just voted it to vote it. And, they didn't know what was going on. So a tremendous amount of pain in the area of medical insurance. I saw it. We were just talking about it, but I saw it firsthand. So I had a bad accident in the end of August, my first day in the hospital. Think about it, my first day. I got admitted at 3:00. Now, I had brain trauma. I was in a coma. It was a bad deal.
Can you tell our audience, you could tell the real story, or you could tell them the elaborate story of what happened. You were in a superhero fight. Is there a superhero story to this?
I wish there was.
Tell us the story, because our audience absolutely wants to know what happened.
I had a house we have a second home in Palm Desert. It was 116 degrees outside, and my air conditioner was only cooling the house to like 84. So I went and got a big box fan, and I was going to blow it through the evaporator to help the motor and cool down the house. So I get the box fan, I put it on the roof, and then next thing I know, I'm waking up in the hospital 5 days later. So I don't know if I fell off the ladder at the top getting on the roof, or was on the roof and fell off.
I'm going to make sure my wife watches this video very closely, because if she ever asks me to do like heavy labor, I'm going to just point to be like, listen, I can't afford it. I'm learning from Wes Sierk. These are things I'm not going to do. I'm not going to get on my roof and try to install whatever the heck you just said. Anyway, back to the story. Sorry about that.
But no, the neurologist told me 50% of people who fall from their height or above and hit their head die. 50%. So I landed on the concrete, cracked my skull. It was it was touch and go for a couple days, but it was a long recovery when you have a brain injury. But now I'm probably 90%. But the first day, I got the bill from Cigna. You get your EOB statement that says this is what it is. The first day was $166,000.
Oh my God.
And they negotiated it down to like 80-some thousand.
Was there like an amazing foot rub? What was $166,000? That's really nice.
Funny you should say that, because there was bills. It was 44. They negotiated down. They paid $4,400 to a physical therapist for physical therapy session. So I called up Cigna, and I'm like, this is your money. I have my deductible. But you just paid $4,400 to a physical therapist to do work on me when I was in a coma. Really? And they're like, well, she probably came in and she had to move your legs from one side to the other, and they're buying their own stuff. And I'm like, this is completely crazy.
Wow.
But insurance companies now, health insurance, they're limited. They have to pay out 80% of what they take in as premium out in medical care. So if you think about it, if an insurance company is living on 20% and they need to make more money, the only way they can make more money is paying out more money.
I think what you're saying is maybe insurance companies are not run as efficiently as they could be.
Horribly inefficient. Yeah.
And I think the world kind of senses that, but the world is not that great at math. So, we need people to kind of break down the math, to see the numbers, right in our face, to make it as shocking as you see it.
Yeah. But clients are saving by creating their own captive. We create it for them. They're doing their own medical insurance.
Got it.
And they're exempt from all those silly rules. Then we go and get reinsurance to protect them. But the best part is we're using reference-based pricing. So instead of paying out, like if you get a Cigna, Blue Cross Blue Shield, they have a network of doctors and they have a set rate that they pay these people. And in California, the report just came out for the nation, but in California, on average, health insurance companies pay 600% of Medicare.
Wow.
Which is huge. So the same hospital that charges a Medicare person $1,000, they're charging health insurance $6,000, and health insurance is paying it. So now, with reference-based pricing, you basically say, you can bill whatever you want. We pay Medicare plus a percentage, Medicare plus 30%, Medicare plus 40%. So, and it's been hugely successful.
So what strategies, I mean, obviously the captive is amazing. It reduces risk. There's a huge tax component as well. But how do you do due diligence on whether these strategies and these things are comply with the tax code on the state and federal level? Let's talk about your due diligence.
I mean, the IRA, you have state and then you have federal. That's a great distinction. So the federal government has very strict rules on what you need to do in order to be an insurance company for tax purposes. So they have rules. Those are, once you understand the rules, you're fine. There have been a bunch of people who went out and got audited on their captives. And right now there's 1,200 cases in tax court, but those are people who didn't follow the rules. They weren't doing it for the right purposes. Remember, all of our discussion has been around what kind of risk do they have? Is it workers' comp, medical, contractors? We're doing a lot with contractors for general liability insurance because it keeps going up and up and up. So we start with regular insurance, their real insurance that they need, and see, can we do it more efficiently inside of a captive? And oh yeah, there's tax benefits to it. But it starts with what is the risk of the business? Where too many people, they start with what are the tax benefits I'm going to get? So how do I need to put $1 million away? And that to me is a recipe for disaster.
So really your foundation, how we start thinking about planning is really important. You need to have real risk. There needs to be significant revenue, significant moving parts, the real need for an insurance. And then you start there, and then all the other benefits are kind of thought about in conjunction. That kind of what keeps you and your clients safe and from potentially violating certain things that the tax code doesn't want business owners to violate. Is that what you're getting
correct.
at?
Yeah. And there's something called TCOR, total cost of risk. So generally speaking, the IRS says a company's total cost of risk should be 10% or less. Mm-hmm. So if you make $10 million in revenue, your insurance should be $1 million or less. Now, there's certain industries where it's more, but what gets these people into trouble, the cases in tax court, you've got one where they did $2 million in revenue and they put in $1.2 million in premium right up to the firewall. All of the tax court cases that came out and came against the taxpayer, they've all had, their total cost of risk is 20, 30, 40%, more than 50% in one case. And that's where you're like, it's a bad set of facts. And then people are like, oh, captives don't work. And it's like, well, yeah, they work. They don't work if you have a crummy business that doesn't really need it and you're doing it for the tax benefits.
Right. I mean, there's a mindset of trying to push the envelope and trying to take advantage of certain laws. And that's what we love. That's what our community loves about you. Our community is made up of family office leaders, elite CPAs, tax professionals at the highest level, former KPMG, former PwC, Deloitte, the big names who've left those firms, have joined our community. And what I love is seeing them pepper you with questions and seeing you answer those questions and get into our group discussions on a community level. Because what's really cool about you, Wes, is you are fluent in not just captives, but many other strategies that we like to combine. And when we combine them, we have our community of attorneys and other CPAs and family offices put pressure on them with questions. And as a community of thought leaders, specialists, and CPAs and so forth, we're like undressing and redressing these strategies and kind of looking at them really closely and saying, where is the risk? Is there audit risk here? Is there tax court risk here? Talk about you being part of our community and kind of throwing everything in the soup bowl, mixing it up and seeing what comes up in terms of ultimately the goal is to reduce the client risk, reduce the CPA's risk, and create something really amazing for that business owner.
Yeah, and the good thing about dealing with the people in your network is, I mean, I don't mean this pejoratively towards other people, but they're at a certain level. They're at a high level. So it's one of those, you almost pay money for who's not in the room in your organization. But once people get to a certain level in their life, it's not worth the risk to save somebody some money on taxes. You know, I'm never going to lose my home because you have a guy that wants to save money on taxes, that wants to do a captive.
Right.
It isn't worth it to us. You know, it also isn't worth, you know, we know all the regulators intimately.
Right.
That we have to go to. And if we were to submit one captive, I mean, we submit a captive, we've got an approval in 24 hours, 48 hours. If we were to submit one that's questionable, where we were pushing the envelope at all, what happens is that one may or may not be approved. But what it does is it puts into question all the other ones we're going to do in the future and the ones we've done in the past. So you get to a level where it's not worth the risk. So I always put it through the frame of not, does the client want this or need this? It's, can I justify it? Can I justify it to the regulators? If I'm in front of tax court, can I justify it that way? And if any of those are no, then it's like, yeah, no, I can't do it.
See, when I first started, I wouldn't be able to differentiate between you. I mean, obviously I like you and love you. I think you're amazing, but I wouldn't be able to differentiate your ability to do due diligence with maybe the number 2 or number 3 captive provider in the world. And so as, you know, now 12, 13 years down the road of you know, you and I working together, it is amazing how I can look at what you're doing and how I really understand why our community is drawn to you. And because our community is CPAs, guess what? CPAs don't like risk. They hate risk. They hate audit risk. They hate tax code risk. They can't stand it. They're not risk takers in those areas, which is awesome. But they're professional enough to know, here's a tax code, here's what we know in the tax code. And when they start putting pressure on different strategies and different resources and different people, the truth at the end of the day comes out. And what comes out about you every single time is your consistency of risk elimination and starting with that foundational principle. And it's just internalized with you. That's just who you are. You're not an aggressive guy. And that's when we meet aggressive marketers or aggressive promoters, that's our job. You mentioned something, you know, you pay for people not to be in the room. We don't want a lot of people and their opinions in the room. We just want the opinions and questions coming from the top professionals who are all risk averse, putting pressure on each strategy, each resource like yours. And then at the end of the day, the cream is going to rise to the top. And that's, you know, so every year that goes by, we just gravitate you more and more and more. I don't know what we do if we lose you, you know, in that August disaster. But I know your team is very, very deep, and you've got amazing people on your team.
Yeah, so. and thanks for that. And you know what? It's interesting. I always knew I had a good team, but you don't know how good they are till the chips are down.
Yeah.
And there wasn't one client that was like, "Wow, I didn't get the service," or "I needed you there." You know, I got a lot of, you know, get well wishes and baskets and stuff like that. But you know, it became very apparent who was a player and who was a pretender when they're left for 4 months. And I have 2 other partners that, you know, kept everything running. And, you know, we have 3 different offices in 3 states, and, you know, everything kept going. So it made me feel good that we built the team that can handle everything. We have CPAs on staff. We have the people that can get this going. I was just going to say one other way that we've worked with the regulators that I think differentiates us from everyone else out there. I don't know of a single other. Remember, my background was insurance.
Sure.
And we ran our own insurance company. So when you run your own insurance company, you can't just decide on the premiums. The premiums are what they are. You have to file those with the Department of Insurance. And then you come in and say, I've got a manufacturing company and we've got this amount of payroll. So we go in and we say, okay, this is your SIC code. This is what your payroll is. Boom, we figure it out. This is what your XMOD is. And it gives us a premium. We have very little wiggle room. You know, it's 8% to 10%, depending on the state, up or down above that.
Mm-hmm.
Where we took that same approach, and we actually went to the different jurisdictions in which we work. And we said, we just created an underwriting model like a real insurance company that nobody else in the industry has. So we put in the client's revenue, payroll, employee count, SIC code for what is their job, and it pulls in, so it goes through our whole rating model, and then it pulls in AM Best premium and rates for all these different industries. So, because one thing that the IRS looked at in these audits is they said, okay, you know, let's take cyber as an example. You have two businesses that are exactly the same amount of revenue, and one person's cyber is 100,000, and one person's is 900,000. You know, the IRS is like, what's your reason for that? And there is no reason other than they wanted to increase their premiums for a deduction. So what we did is we went in and we worked with the regulators. So now our system calculates the premium and it cross-checks it against AM Best premiums for those different SIC codes. And it says, hey, you know, it gives us flags. This one's off. But if it's off, we have to figure out why. Oh, it's because this guy had 3 lawsuits in the last year. So at least gives our underwriters a check. So if you had 2 people that came in to do a captive for us to do a preliminary analysis on, their premiums are going to be roughly the same. You know, it's all based on what their industry and everything else is. And we've taken away that ability for our underwriters, because you came back and you're like, you know what? This guy really wants a $2 million deduction and you only got to 1.3. I'm like, yeah, 1.3 is what he's going to have to settle for. Use one of your other strategies to get the other 700. We don't have the desire or the ability, because we have to go back to the regulators and say, hey, we're rewriting this for this person, and it's just not worth it.
Wow. So, I mean, this is the attention to detail that we really appreciate. We appreciate this from every one of our resources. We're not going to interview every one of our resources on the Due Diligence Project podcast. We wanted to share some of Wes's unique wisdom with you guys. But before we take off here and let you enjoy the rest of your day, can you share some victories that you have, some client victories that you can share, just to give us a little taste of what happens?
Yeah. Let me see. I have this because I'm going to review with this client tomorrow.
Okay.
All right. So we took over. We can't share screens, can we?
We can. If you want to share. I mean, I would just verbally share it.
Okay.
But yeah.
So it's perfect. So these guys have, they started out with, they've been our clients for a captive since 2014.
Okay.
And 2016, they came in and they're like, oh, this sucks. You know, our medical insurance keeps going up and up and up. We're self-insured with Cigna. Is there anything we can do? And I said, well, let's take a look at it. So in 2015, their total premium for medical was $1.86 million. So then it went to $2.6 million in 2016. And then that's when we took it over, because we're like, yeah, you know what? It just isn't right. So we introduced reference-based pricing. So all their people could go to any doctor, any hospital. All of it's negotiated based on Medicare. So in 2017, it dropped to $1.503 million. So they saved $900,000. It's an employee-owned company. That $900,000 they saved went directly into the pockets of the employees.
And that's just 1 year. That's first
1 year. So it could have been luck, right? 2018, the total spend was $1.327 million. So 2 years, pretty good. Their employee count went from 279 people to 270. So it went down by 9, but that doesn't account for if they were at $2.6 million in 16, then it was going to go to 3 million in 17, would have gone to 3.2 in 18. But here we've dropped it from 2.6 to 1.5 to 1.3. And then in 2019, their employee count went to 309 people. Their total paid claims went to 624,725.
So they're doing
They're $2 million less in 19 payment than they were in 16 payment.
Wow. So there are things that are happening when you stop buying insurance at retail and start implementing your own insurance company. When you own an insurance company, you take care of it. Maybe people are eating better, maybe they're exercising more, and all of a sudden they're getting healthier because at the end of the day, they're going to have to deal with the claims because the owners own this insurance company. So there's a lot of other benefits that are happening besides the initial cost savings, right? There's risk displacement, but there's a healthier, it seems like the employees have less claims, just a healthier company.
They're healthier. And so we went back to them and we're like, you're saving all this money. Let's give back. They're like, well, what do you think we should do? And I'm like, well, let's get rid of co-pays on medication and office visits. And they're like, oh, we can't afford to do that. We would go broke because they were charging them like $20 for a copay on a prescription drug and a office visit. And they went round and round and round about how they would go broke and they just don't have it. And I'm like, you've saved $900,000. I'm like, take a guess how much your employees spent last year in copays for doctors. And they were shooting like 200,000, 180, something like that. I said it was $8,800.
Wow.
So they got rid of $8,800, but now as you're an employee, you don't make that much money. So now you don't have any copay to go to the doctors, to take your kids to the doctors. You need prescription drugs, you don't have a copay. I mean, that's huge quality of life things for these employees.
That's awesome. So so you've saved this company a tremendous amount in just an unnecessary cost. I'm sure there was some tax advantages there that we haven't even discussed that are very significant. Plus, they're able to take some of this cost savings and benefit their employees, which is probably the lifeblood of this company.
Correct.
And creating better communities, stronger communities, supporting these families. There's children involved. I mean, this is what we're talking about. And we're just scratching the surface. Wes, thank you so much for what you do. We're going to do this again. We're going to interview you again because we could probably spend another 3-4 hours diving into your brain and picking out stuff that our audience would love to really get a better handle on. But this was great. Thank you so much for
something.
Yeah,
something
go ahead.
popped in my mind. Not to cut you off, but we do a quarterly win in our office where all the employees, we say, okay, these are the cases we've worked on. This is, because a test of a good decision is a test of time. So what we do in those quarterly wins is we go back to somebody that we did in 14, 13, 16, whatever, because anyone can have a bad year, and we tell people that up front, but it's to go over. So, I mean, I'd love to share that with you guys. That way you can see on it, wow, this is how much they've saved in premium. This is how we've improved the quality of life on their people. And, oh yeah, there are tax benefits, but you think the tax benefits they're even thinking about that when they give their employees no co-pays and they've saved $2 million over where they were in 2016. The taxes, that's not even on their mind.
Right.
Benefit, yes, but it wasn't the driver.
Absolutely.
That's what the issue the IRS, has.
Absolutely. No, I mean, that's critical. We talked about the foundational way that you think, the way that your firm thinks, the way that you're thinking, just really from the IRS's standpoint, making sure everything's compliant. We're not going to cross any lines, any gray area. And this is really what our community does. And look, our CPAs, they don't want to put their clients in any situation. But, when we're talking about the kind of value that you bring to the table, it's off the charts. And like I said, this podcast just scratches the surface of what you really bring to the table, bring to our community, bring to me personally as a friend and as someone I go to. When I see unique situations, you're one of the first people that I think of to call to get your feedback. And so you're really part of our inner circle. We consider you a board member of the Due Diligence Project that never stops. We never stop doing due diligence. When you build a captive, I'm assuming there's going to be attorneys and CPAs and all sorts of third parties looking at it. Guess what they're doing, Wes? They're doing due diligence to try to find that risk, to try to find a way. Hey, maybe you're doing something a little bit aggressively. We've never found that about the way you do things. In fact, we actually push you to try to be more aggressive. And so that's what we appreciate as a community about you. And like I said, we're looking forward to interviewing you again. I'm glad you're feeling better. If this is you at 90% and you're still you're still in the number one chair, can you imagine, how smart this guy was in August before he tried to do manual labor on a rooftop in 120 degrees in the desert. So nobody's perfect. I'm glad that you showed us that, hey, you're not perfect either. I certainly know. My wife points out to me constantly that I'm not perfect, which I'm really grateful for there. But today we saw a little imperfection from Wesley Sierk. And so our audience really got a chance to dive in, get to know you a little bit, and always a pleasure, my friend.
Thank you.
Thank you so much for joining us. I really appreciate it.
Bye-bye.
That's all for this episode of the Due Diligence Project podcast. Be sure to visit duediligenceproject.com to access the resources we have available for qualified CPAs and family office leaders. Our mission at the Due Diligence Project is to help you deliver more significance and value to your very best clients while shifting your traditional practice into the firm of the future.